Your friend comes to you and tells you this very compelling story about a company that's now selling stock and he thinks you should buy. Is it a hot tip or is it a dud? How to evaluate a stock? That's the topic of today's video. Oftentimes, when folks evaluate a stock, they start and end with the story. Companies can have very compelling stories, but you need to dig a little deeper and look at the numbers, the ratios, and the equations to see whether or not it would make a good investment. Let's use an example here of a vending machine on Front Street in Harrisburg. That's where my office is located. And imagine I put a vending machine out there and it is self-serving. It turns a profit of about $1,000 a year. So with no effort, no input from me, I have this vending machine that's making $1,000 a year. I decide that I actually want to go public. I want to sell stock in my vending machine company, and I offer the company up for sale. Now, over the years, I've worked with many farmers, and they would come to me and they would say something like, "Matt, I'll offer you $500 for your vending machine that makes $1,000 a year." And of course, I would say no, thank you. But farmers are very frugal. They don't get paid very often, so they're very conscientious when it comes to spending cash. But a small business owner might come by, and the small business owner might look at this and say, "You know what, Matt? I'll offer you $3,000 for your vending machine that makes $1,000 a year." We would call that a price per earnings ratio. And in this example, the price per earnings ratio is 3-to-1. So for $1,000 worth of profits, the buyer is willing to pay $3,000 for those businesses. Now that's a very typical price per earnings ratio in a small owner-operated business. They typically sell for about a 3-to-1 PE ratio. Now let's say that it's a bigger company. Instead of just having vending machines in one location, it's vending machines all over the place, and there's a team in place that takes care of everything, so the owner doesn't have to do anything. Well, the stock market is really based upon companies that you're not expected to participate in the management of. So when you buy stock in a publicly traded company, a very good long-term sustainable price per earnings ratio is 20-to-1. That means for every $1,000 worth of profits per year, you pay $20,000 one time upfront to buy the stock to own that $1,000 worth of profits. So that's a price per earnings ratio of 20-to-1. And that is a reasonable price per earnings ratio in the stock world. Now, let's take it one step further. What if I was to put a solar panel on the roof of that vending machine, and I was to say, "This is a Tesla, and now I'm selling Teslas. It's the best vending machine out there. It's amazing, it's fantastic, it's good for the environment, all that stuff. Great story." But would you be willing to pay $680,000 for that vending machine that makes $1,000 a year? I would have to say no. If you're good at math, you would never sign up for that. But that's exactly the price per earnings ratio of Tesla at the time we're recording this video. It's 680-to-1. Does that seem like a reasonable price to you? It does not seem like a reasonable price to me. That's what I would call like one of these meme stocks, where it's going to be very volatile, it'll have a flash, and it might not support itself. But you know, there's also companies out there that have a stock value or a stock price, and they're actually posting a loss. They're losing money. Why would somebody pay money to buy a company that is losing money? Well, the reason for that is they expect some type of turnaround. They expect that the company will start to make money again at some point in the future. You're definitely taking a big risk with that, though. There's also a price to book ratio, which is really very important with a company that's a startup or maybe is struggling because it's going through a period of losses. This would be a great example of the cruise line industry. 2020 and the first half of 2021 were both miserable years for the cruise line industry. No revenues, lots of expenses, huge losses. Well, price per book says if you compare the price of the stock to the actual hard assets that are backing it up. If a company has a decent or positive price per book ratio, it might be worth looking into buying them, like possibly buying some cruise line stock, even though they have not yet returned to profitability. So price per earnings ratio and price to book ratio are 2 ways that you can evaluate a stock simply beyond the story, because it really comes down to the numbers. If it's too expensive, it's not worth it. So if you'd like somebody to take a look at your portfolio and help you evaluate whether or not it makes sense in your situation, that's what we do here at Taylor Retirement Services. We'd be happy to help. Just pick up the phone and give us a call, or check us out online at taylorretirementservices.com.